Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Aaron Marsh. He is the founder of Marsh Lending, where he helps clients navigate the complex financial situations and access real estate opportunities through a relationship-focused approach. With over 30 years of experience in finance and leadership, he specializes in working with investors and individuals who don't fit traditional bank models, using creative financing strategies to secure funding. He also is very passionate about educating others on real estate investing and helping them build wealth and make smarter financial decisions. Aaron, welcome to The Wealth Flow.
Hey, glad to be here. Thanks, Keith, for having me on. I really appreciate it.
Yeah, I'm looking forward to our conversation today. Always do like to start with each guest on kind of their background, where they grew up, what eventually got you into this world of real estate investing and lending.
Yeah, no, like you'll hear a lot of people that are kind of on this side of the business or this side of the seesaw that I didn't, grow up wanting to be a lender or a mortgage person. I just kind of fell into it, and that's kind of one of our stories as well. So, background. From the Dallas area as a small kid. My mom moved to, I'm dating myself a long time ago. She moved to the North Shore of Hawaii when it was still kind of very country hippie-ish out there, and so I'd go back and forth to the North Shore of Oahu. I lived out there for a number of years, came back to the Dallas area, finished up high school, and then went to college in Texas. And then I just kind of started my traditional career, right? So I was always intrigued by finance. Wall Street had just come out as a big movie when I was in high school, Gordon Gekko, all of those kind of things. And so, I went the stockbroker route, and back then it was kind of just the early days. It was kind of pre-internet. There was like kind of a communications between us and the Chicago Board of Trade, or us and the NYC SE from the brokerage that I worked at, but it was just, you were there all day long making calls for your senior broker. So I did that for, a while, and, it's long hours, you're starving to death, you're working, and then you finally get to work on your book of business. But, all of my contacts were all my college roommates and friends. So they like, yeah, no, I don't have any money to invest, but do you want to go out this weekend? Those kind of things. So I said, I got to get like, quote unquote, a real job, corporate America. And so I just got into corporate America. I was in finance and operations, predominantly in the retail world. I was, the kind of the halfway point on from, my career. I was 20 years at JCPenney's in the corporate headquarters there in Dallas. And so, and then, I was finance and operations on the whole private brand label stuff, and was in with a lot of their planning and allocations. And so I got to see everything from soup to nuts. So the area that was under my purview was from when a designer on our team would draw a dress or a shirt or something out on a piece of paper, all the way through getting, it tech designed out, and then samples. And then my team, we worked overseas as well. and with the manufacturers and trying to get all that done. So I did that for a long period of time. But how real estate has always been close to us because my mom was in real estate when I was a young kid, and my grandmother taught her to be in the business. So, my mom and my grandmother would go do these real estate deals, and it was basically me in the back seat, the two of them in the front seat, driving around to the buyer's house to sign all the contracts and everything. And then they take all that paperwork and they drive over to the seller's house and sign everything. And then, this would be at night or weekends or something like that. And we'd stop for ice cream or whatever. But it was, it was kind of an indoctrination before DocuSign and any kind of internet or any of that kind of stuff. It was all, I'm taking a file of full, from house to house to the title company and everything else. And that's how they got deals done. So,
yeah,
real estate was always something that was in my world. And flash forward all the way up to the pandemic, everybody's at home, and we had a friend that had a boutique firm, and he said, "Hey man, I'm getting killed with all these refis. I need some help. Can you, you're not doing anything, you're just at home. Can you get online and take a course and pass the test? And then, I'll bring you on, and then, we'd help me out with these refis." And so I wasn't actively, going out to build a book of business. So I was just doing refis for friends and family, right? So anybody that had a 6, 7, 8% loan, when they crushed down to 2.5% to 3%, I was just helping them, our family and stuff out doing that. And then, we had a house in an investment property. We had vacation in this area in Florida, for 20 years. And there was a vacation house that we bought that was down there, and we did the short-term rental investor thing. And then we'd come visit it when it, check on it when it was in between, rentals or, seasons and that kind of stuff. And we were going back and forth. Our last one was out of the house going to college. So we sold the house that we had in Dallas and we moved down full time. And I said, look, I'll do this for a year so I can get get my brokerage license here in Florida. And so, I did that because I found a niche where I can provide a service that banks and credit unions have a hard time getting to. And it's all the stuff that you described in the bio. We really have a, kind of a server mentality and a partnership with our clients and investors to get them loans and stuff that eases up, gets them the best value, the best rates, eases up some of the underwriting rules or the no's that banks and credit unions can give you. And that's how, and then we kind of got to here, and we just been growing it since. So yeah, it's been great. Good journey.
Yeah, no, sounds like a really good journey. And man, those were the days when the rates were down in the 2% range. And I'm sure, at least for somebody doing refis, man, what a great time to be in the business and learn a lot.
It was a great time to be in the business, but it was a bad time to buy an investment house, and that's what we did. So when we came down, we were all over the place, looking at different houses, and literally we'd walk in, and our realtor would look at his phone and go, "Okay, if you like this, you got to be at 5% over asking because they already got 3 on it." Right. Or we go, "Hey, one just came up. Let's go there." And it was pandemonium. They were writing, when we sold our house in Dallas during that time, we sold it in one day. It went on, we did an open house,
that's awesome.
Done that day. Yeah. So it was great.
Yeah. Well, tell me a little bit about, you mentioned in there, in a lot of times where credit unions and banks can say no. What are some examples of that where they can't see necessarily some of the things that a lot of times come up with a real estate investor type client?
So, a lot of times they come up with a few different things. One is, let's say you're an investor and you, through your tax advisor and everything, you set your houses up to where you have an LLC per house, or you have an LLC per state. So I got 4 houses in Georgia, and they're this, 4 houses in Alabama and 4 houses in Florida or wherever, right? And they're all under different LLCs. Or maybe you're just a serial entrepreneur. You have you belong to a lot of LLCs from an advisory standpoint, and you have your own. So when you walk in, I always use one of these clients as my example. So, he and his family own 20 car dealerships or something like that, but all of them are individual businesses, they're individual entities. So when you come into and you're like, I just want to buy this property. Yeah, but we need to see all of this stuff, even the closed stuff. We need P&Ls on things that are, even closed. Well, it's not an operating entity. We closed it down there during the pandemic. We may open it back up. We may not, right? And so that's a big one, is when you've got a lot of diversity to your income stream, right? So your layer cake for your income is huge, right? And so that's one thing.
Right.
Another one that they barf on is they always try and fit you into a DTI, right? So then they're like, well, you're like, well, hey, yeah, I'm gonna use my rentals on that. Well, our bank doesn't do DSCR loans. So, okay, so what do I got to do in this? Well, you're gonna have to fit this $2 million house underneath all your other stuff, right? Your stack. So they'll say no on a lot of those things. The other thing is they come up to cap limits. So there's a lot, especially in today's world, right? So in our area, a lot of the short-term rentals, they'll sleep a lot of people. There's a lot of them that are on the beach, and they may be $5 million. Well, if I want to do an investment loan, I want to get you in at 20 or 25% down. So you're paying $1 million, $1.5 million down, but then, but that still leaves you with like a $4 million note or $3.5 million note. Well, the banks are like, no, we cap out at 3, or we'll do your $3 million loan, but then you got to part 5, 10, 15% of that money in our little bitty bank, and hold it there for, 3, 5, 7 years in a CD or something like that. And many of these savvy investors are like, why am I going to take something out of the market where even in the S&P I'm making 12% and put it down for 4% in your bank because you want to give me the loan, right? So time out on all that stuff. So that's really where we've gotten a ton of referrals, right? So there is a lot of competition in what we do, from banks, credit unions, online bots, bankrate.com, ChatGPT, all those things, right? But where we kind of set ourselves apart and we got hyper focus is in that top right quartile, where we're like, okay, from a complexity and dollar amount axis, right? So low complexity, low dollar amount, like entry level homes, first time buyers, cul-de-sac houses, that kind of stuff. There's a huge amount of people that can give you a loan. It's bountiful, right? Then when you get higher complexity, low dollar amount, then you start getting into like the weird DPA situations, or, you're trying to do something funky with some really wonky gig, background and all that kind of stuff. We can help you with that. But then the dollar amount is very kind of low. But really where we are is in that right quarter, high complexity, high dollar amount. We got you covered.
Okay. Well, okay. Give me some examples of that then. Like what type of, are you typically doing loans for short-term rentals, or what kind of investment type loans are you doing?
So because of the area we're in, we're well versed in that. That's wheelhouse for us, right? So that's, dead red right down Madison Avenue for us. Now, the other thing that we do is we get into a lot of multifamily, and we also get into a lot of mixed use, where it's retail on the bottom and lofts, condos, that kind of stuff on there. We're doing more and more kind of new developments, especially on the spec home side, right? So a developer comes in, they buy a plot of land, they do all the horizontals and cut it for like 30, 60 lots. And then they want to work with an investor A to get the new construction loan started on all these spec homes, but then also, can we help them out on as either a vacation home, secondary home, which we don't do a ton of those, or a primary residence. We can help the clients out, once they buy the house, right? After it goes from spec build to a purchase. And then we're starting to get into, we do like some business to business that we have relationships with, private office, private family money, and some equity groups that will get into that kind of business to business, right? So someone's buying a car wash, they're refinancing a car wash, they're buying a a marina, so, all kinds of things. So we get into some of that too as well.
Okay. So there's some commercial stuff in there in addition to, some of the, there's a decent amount of commercial that you listed off there.
I would say, yeah, right. So even our short-term rentals, those are all business purpose loans. They want to take advantage of the cost seg studies, the bonus appreciation, the new bill, the big, beautiful bill, those kind of things. So, and then I would say in our area of influence, right? So wherever we're 15-mile famous, we definitely are close about 90 something percent of our deals in an LLC, and it's a business purpose loan, whether it's a bank statement, asset depletion, income stack, portfolio loan, DSCRs, all of those, we really, I would say that's the bulk of our business. Primary homes, that kind of stuff, we do them, but they just, because we are so good in what we do on this side, we do those for clients, but we don't necessarily focus on that.
Yeah. No, that's great. And maybe for the audience, we could talk a little bit about a couple different things that you mentioned. But let's start with those LLCs. And why would somebody want to put their property in an LLC? Obviously, there's the protection side of it, but I just want to kind of maybe have you and why would some banks not allow that? Because that is a real deal. A lot of times people do not want to have it in an LLC, and trying to change it to an LLC afterwards, can potentially cause the due on sale clause, and as if it was sold to somebody without letting them know.
Yeah, you kind of get into that whole. I don't want to flirtate with mortgage fraud, and that's a big thing out there in terms of ownership, right? So you have to declare, is it owner occupied, is it non-owner occupied? And then if it's non-owner occupied, did you put in your personal name and this is like a quote unquote vacation home, second home, that kind of stuff? Well, then there's rules around how often it can be on Airbnb or VRBO or run by property manager. How often you can short-term rental it? Conversely, if you put it in an LLC and you do it and you classify it and invest it as a business purpose loan, then I think you're setting yourself up for success. And this is what part of the partnership that we coach our clients all the time on, right? So the putting it in an LLC, then you can set up a bank account around the LLC. You can have all the income and outputs, expenses flow through there. It's easier from a tax standpoint. It's easier for you from a tracking standpoint. It's easier for you from a write-off standpoint. And then also it kind of keeps you at arm's length. Now, a long time ago, and we still get questions about this, like, well, I'm going to put in an LLC, but I want it to be non-recourse. Well, kind of the non-recourse days are over. You're going to need to be like a personal guarantor. LLCs don't have FICO, so they're going to take a FICO from someone that's part of the LLC. So if it's you and your wife or you and 3 friends, whoever you want designated that has the best FICO, that's what we're going to use to help set the rate, right, for the loan, even though you're closing an LLC. Okay. But I would say the advantages from the LLC are just like you said, there's a protection aspect. There's a whole tax advantage aspect. And then also it kind of helps you create and build your pyramid of like, what does my net worth look like, right? So I got my private stuff, I got my business stuff, and I got this property, even if I got one property in my LLC, I've kind of created a holding company over here, right? So I got assets underneath it and that kind of stuff. And so that's really why we coach it. And like I said, most savvy investors, even first-time investors, they'll jump in on the LLC once they start to kind of unpack it a little bit, do their little chat GPT homework or talk to their tax advisors or talk to someone like us or their wealth advisor, those kind of things.
Yeah, no, it makes total sense. And if you can have something like you mentioned, it's kind of a big deal to have the, having everything underneath. I mean, we have one of our short-term rentals that's not in an LLC, and it does have its own account, but there's always stuff that eventually comes from one account to the other, and it's not all tracked there. So it would be much cleaner, much nicer if it was just under an LLC, even with with all of the bills, putting all the utility stuff underneath there and just designating it truly as to that property from a tax standpoint, just being easier to keep up with. Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show.
And also think about your flex, right? So you can throw up your dashboard and then your QuickBooks is all pointed to just your LLC account, or if you have multiple, and then all your short-term rentals in there, and you can flex and say, oh, wow, look at this. This is our income and here's our expenses. Here's our net profit, without having to do all that extra math of, okay, we got to add in, this deposit this month from here. And then, had to buy a washer and dryer. So that from here, and this credit card, and all that kind of stuff. I think it's just really, it cleans it up a little,
Yeah, for sure. Maybe we could stick on the short-term rental, because you mentioned something that not everybody is aware of. We utilized it on our first short-term rental, which was the cost segregation study. A lot of folks don't recognize or realize that they can do that on a single-family type residence. You want to maybe kind of go through the details on why, number one, why would somebody potentially want to do that? And just what you see with your clients with respect to a short-term rental.
Yeah. So, okay. So what we can talk about it this way. Let's say someone has done well in their business, right? And they got a windfall, right? And so they're going to, corporately, they're going to have to pay a bunch of tax on that, because they own their own, let's say it's their car dealership and they sold a crap ton of pickup trucks this year, right? So they're way over year, right? And so they got to do something with this. And so they have a cash outflow to them or inflow to them. So then they may want to put that into a short-term rental, create an LLC for it, or keep it under whatever vesting structure they want to put it in. But then they'll put a heavy down payment into it, right? And so then what they can do, if they want to, right? They can put 25% down, and then you do your cost seg study. And once that comes back, and then that depreciation is identified, and you'll work with your tax advisor on a lot of this stuff. And there's also cost seg study professionals out there, but a lot of that can come back into year one to where it almost pays you completely back from a tax standpoint. Your down payment that you put out, right? And then also all of your closing costs, any points and fees, any of those kind of things. So that year one, you're almost whole again. Or we've seen it before where people come back better than whole, right? And because their cost seg study came back so favorable, right? And so that is highly attractive to short-term investors or even long-term investors. Let's say you're buying like a duplex and you want to rent out both halves of it, or you're buying out a quad or multifamily, and it's already got, long-term contracts in place or, leases. You can do the same thing again. And then now I'm kind of whole. And then now I'm just taking in and offsetting my monthly expenses with the leases.
Yeah, for sure. Yeah, I know in the instance with ours, we had sold commercial property that we had that same year, and that was part of the motivation. I bought it kind of towards the end of the year, but it was significantly more than what I put down. I put down 25%, but it was significantly more than that we got the write-off for. So, it's just one of those additional things if you're investing in real estate that can come in handy. And we just did one this year for a property we bought a couple years ago. And got a large depreciation on, and so I mean, and again, it offset some gains that we had last year as well. So it can be a really good tool to be able to use that not everybody's familiar with. So,
and it also allowed you, like you said, the complete equilibrium is there. You've offset as much or more than, so you feel like you're whole again, but then you've also increased your net worth, right? So now I've increased my net worth, and it didn't cost me like, an arm and a leg to get to that increase of net worth. Now you're kind of growing. And this is what is great about your show. So one of the things that I think is is really not out there enough is people like you putting out there are different playbooks. I didn't realize this different playbook until, some time ago, right? But there are different playbooks out there that you need to be aware of, take advantage of. And like your show is kind of helping people understand, even if it's what we call Henrys, right? So high earners, not rich yet. And so they're W-2 employees. They love vacationing at this place. They would like to have a place of their own. So every time they drive down to the beach or they go to the mountains or go to, the big lake that they're at, and they stay in an Airbnb all week, and they're like, oh my God, wouldn't this be great if we have it? How do we make this happen? Your show kind of lends to that, right? So your show and shows like yours are offering up the playbooks that say, okay, this is doable when we thought it wasn't. Right. Because everybody thinks, oh my God, we could get a second mortgage on a house. It's 3 states away. How do we make that happen? And, I think that's what needs to be out there more, is people understand that there are ways of getting this done, whether you make a lot of money or a little bit of money. Right.
Yeah, for sure. Let's also maybe for the audience that's trying to understand on some of this, the like debt to income ratio. You mentioned that some of the types of loans that you're able to do, maybe it's a short-term rental as an example, but that it does not count against that, and that can be detrimental. I know I'll give an example that we had personally. It was right after we bought our short-term rental, but we had no income for that year because we had just got it. It would just So we had no previous year to be able to point back to, and I was getting a HELOC, and the amount of additional money that we could have gotten if it wasn't for that mortgage was substantial. But unfortunately, we didn't let it season for a year, which I just didn't even think about it. But it can make a difference. So it can make a difference for other investors as well. And so just maybe if you want to touch on that a little bit for the audience, I think that would be good.
Sure. So, and that kind of goes back to our earlier conversation about why would I do a business purpose loan, or why would I do it in an LLC and all that kind of stuff. So DTI, or debt to income, is a big factor in that. And then a lot of banks have different thresholds. So I always look at it, when you're trying to get a second property, if you're approaching that kind of low to mid 40s, and you're trying to do it as a second home, which we haven't done anything as a second home in, I don't know, 2 or 3 years, right? I mean, it's been a long time because everybody wants to take advantage of the business purpose loan, right? For all the things that we already talked about. But one of the other big advantages of that is it is quote unquote business purpose commercial loan. So it won't affect if you close it in an LLC, then when you want to go buy a car, or like you said, you're trying to do a HELOC or something like that, that should be excluded. So the debt on the condo that you bought in the mountains or in the beach or by the beach or just as a short-term rental in the city that you live in, that debt doesn't count against your personal DTIs, right? Because you closed it in an LLC, it vested as a business purpose loan, and you can keep that excluded. And a lot of times, some banks will try and include it, but then that's when you step up to the plate and you say, no, that's a short-term rental, it's a business purpose loan. We're not including that in our DTIs, right? And so that keeps you open and liquid and flowing for other things that you want to do personally, right? And so car loan, student loan, all of the things, right? So those are things that you want to try and keep your DTIs as clean as possible and as low as possible. And working with someone like our team or teams like us will help you kind of navigate that DTI water.
Okay. And then how about portfolio loans? Just in general, at what point do you recommend doing a portfolio loan, and maybe just describe kind of what expectations a potential investor would have with a portfolio loan over just a traditional mortgage?
So, portfolio loan to us means a couple of different things, right? So we have products where you can use, let's say you have a portfolio of investment properties already, right? So whether it's a strip center, it's commercial land, it's something. So we can cross collateralize that, right? As part of your income and verification or qualifications for whatever new purpose that you're doing. So that's one thing. It's kind of like, within my portfolio, I can cross collateralize some of these things for that. Another way that we look at it is what I like to call like the income stack or income layer cake, where like, let's say we're doing a DSCR loan and it almost gets there, right? I only wanted to put 20% down because I wanted to be liquid. My DSCR calculation comes up to be like a 0.8. I need it to be a 0.1 to get the rate I want, right? So we offer, 0.75, but there's a little bit of a rate bump on that. So you didn't quite get to equilibrium on the DSCR, or we even have like no ratio, which it takes a little bit of a rate hit on that, but you can still get in it. But like, let's say you want to get to that 1.0, you need a little bit to help you get over the edge. Then we'll take a look at, like we talked about, like a large, like let's say you have a TD Ameritrade account or a 401k or an IRA or something like that. Then we'll put calculations against that. Now, that's not saying that you're pledging it and now it's untouchable because now it's pledged against this asset. It's like, in a vault somewhere. You can still use that account, but we're just using it for the qualification purposes of the loan, right? And so that's another way that we do it. Or like, let's say you want to do like, we've done a couple of these where we bundle some together. So someone owned like 3 different little houses and they wanted to buy 2 condos. We could bundle all those together in kind of a portfolio and do a loan based off of all of them together. So when we say portfolio loan, from our standpoint, those are some of the different kind of pillars or nuances that we can do on it.
Yeah, no, it makes sense. Thanks for clarifying on that. And I was thinking kind of that last example with, call it the 5 potential rental properties under one loan. But
just have just have an MSA, like a large loan agreement on all of them, and then it has a lot of benefits to it, right? Because then you can couple them all together. You can get more, with bang for your buck, so to speak, leverage them.
Yeah, makes sense. And then on some of the various commercial, like I say, I know a lot of this we've been talking has been commercial, but you mentioned strip centers, you mentioned multifamily. Maybe talk a little bit about some of the things that are looked at in the underwriting when it comes to those types of loans.
I think, okay, so let's take them like quickly 2 different ways. So if you're strictly commercial, right, and you're buying a strip center, then they want to look at the health of the operator. So let's say you have 5 different tenants in there. They're going to want to look at the health of their business and the health of those operations. And then what do their leases look like? And what does their payment history look like, right? So like, let's say you bought a strip center and it's got pet grooming, a pizza parlor, and a tax place inside of it, right? So they want to look at how long the lease has been there, what's the strength of them, how, are there any lates, and they just want to make sure that their businesses are healthy and it's something that the lender is comfortable with, right? Not something that's kind of fly by night, right? And then on the other side, if it's multifamily, then they'll also want to look at like lease strength, right? So how much is, or how, in the last 24 months, how often has the building been at least 90% or higher leased, right? Like, it's not like it's vacant or it's like, half leased. If it is, what's the cause for that? Is it new construction? That kind of stuff. And then they'll want to look at, let me see kind of the rent rolls and everything on that. Like, okay, is everybody current? Is anybody got any lates? Is half the building not making payments? And then one more piece of it too that's very instrumental is if they know they've got some sort of quality guarantee in terms of like, is a portion of the building, reserved for 8A, or is there some sort of like, help from a HUD standpoint? Is there like a second lien on there that's HUD supported or something like that? So they'll want to look at some of those things to help just strengthen the profile of the property. The stronger the profile is of property, the less underwriting kind of digs in. The weaker, the wonkier it is. Like, so if you're looking at a potential building that is typically 60%, occupied or 75% occupied, then you'll need to have some really strong letters of explanation on why is it 25% or 40% vacant, right? Or if you look at a rent roll and most people pay, rent's due on the 1st, most of them pay by like the 9th, the 12th, the 15th, then they'll start to look at, well, are you going to be able to pay my note, right? Because the mortgage that we're giving you, what is your underwriting and what does your, personal financial statement look like? And now are you able to pay the note in lieu of like late rents and that kind of stuff? So some of it's intuitive, but that kind of peels back the onion a little bit in terms of like what they're looking at right off the bat.
Yeah, no, that makes a lot of sense. And, I think for the audience, just being able to hear that, a lot of times when you get into the larger commercial stuff, that they're looking a lot at, the building itself or, and what the finances look like on that. Obviously, they're going to look at you as well, but it's primarily, is this an asset that's going to perform? What about from a vacancy rate standpoint? Are there, what kind of a threshold when you get you gave an example of like 60%, and that would obviously they'd want to dig in a little bit there, but like on in general, do you have different lending products depending on where they are with where this building is with the process of either getting it repaired and stabilized and
Right. Yeah. Stability is a big thing that you hit on. So, I kind of say it is a, directly correlated. The more vacancy that you have, especially if it's unexplainable, the more costly the money's going to be, right? There's going to be obviously some points involved. They're going to ask you, do you need to strengthen your ownership because your operators are weak, right? So we'll look at your PFS. Can you carry the note for 6 months? Do you have a liquidity reserve? Can you bring in a partner? What is their PFS and what do they look like? Are you guys able to handle it, from a standpoint of, right? Like, let's say the cost to own and maintain and run the building is 60% of what the total lease value would be, right? If it was 100% occupied. Well, if I'm only 60% lease, I'm barely covering the nut, right? And they want them to see, okay, is there any reserves above that just in case, you fall below that threshold? The other thing is they always look at stability. Do you have some sort of reserve built in, or do we need to build it into the loan that we can draw from in terms of, as you rehab the units or rehab, the parking lot or anything around it, to make it more attractive for better renters. But then also, what's your runway, right? What's your trajectory to get to what you call perfectly stability, right? Or stabilization. And what does that look like? Is it 3 months? Are we 180 days? Is it 6 months to get you to where you're stable? And then let's kind of figure out between your reserves, do you have a lot that you could draw from and would feel okay and you just keep that in the market? Or do we need to build a reserve in that we'll have to draw from because it'll give us from a lending standpoint, a deeper sense of security for our loan to you, right? If that kind of makes sense. But really 90% and above, that's ideal, right? That's where you want to be because you're going to have some monthly turnover and that kind of stuff. When you start getting down in the 60-50 range, we better have a pretty good explanation in terms of like, hey, I bought an older building. I got it at a bargain. I need to build in some rehab into this. I'm not going to fix and flip it. It's going to be a fix and hold. So we're going to fix it, hold it. And here's my ramp to stabilization. And then here's what my GC said in terms of how quickly we can get the permits and get it done. So there's a lot of little, kind of during the due diligence period, all of that gets vetted out.
Yeah, no, it makes a lot of sense. How about from a length of lease standpoint when we're talking, call it retail? I don't know if you guys do any kind of office, but if it's something related to kind of maybe possibly a mixed use, but when we're looking on the more of the commercial leases, is there a specific length that they like to look at, Aaron, or does it really depend on the history of the property, regardless of the length of the lease, if that makes sense?
I that's a good question. We just we've just been engaged with a client on one, and so they're buying the property, but the owners, the tenants that are in the property, have a 25-year triple net lease with them, right? And so
Yeah.
from when we go to the marketplace and go to like our representatives at different family offices that we have partnerships with, or some capital companies, or even like just our private equity groups, and some private banks that we work with, that's one of the things that we lead with. Hey, it's not a 1-year lease, right? So it's 25. So there's some structure there, right? And then also they like to see from, like, let's just keep it on straight commercial from a tenant standpoint, like an office. Is there any personal guarantees for this tenant by someone else, or by like a major shareholder, or by an owner or something like that? Are there any PGs involved? What does their PFS look like, right? And so then we can look at their personal financial statement and try and say, okay, you got a 25-year, it's triple net, good, operation, rent roll from the last like 12 months is solid, and we got a personal guarantor that's worth $100 million, right? That's backing their company or whatever it is. So that makes it strong. When you start get to a position of weakness, like let's say, hey, we only got a 5-year lease with these people. They've been good for the first 3 years. They want to extend another 5 years, so, we're kind of net 7 years, 2 years left plus 5 or something like that. And, and here's what their background looks like. Then all that does is that adds a little bit of risk, but the fact that they have a good record and they're trying to do it. Now, if you got like someone who just came in, it's a brand new business, they're just now starting operations, they're not cash flowing, and they only signed like a 1 or 2 year lease on the deal, then that's when we have to start getting really creative. Do we bring in multiple lenders? Like someone will lend 60 and then we'll have a second for 40, which is hard, or do we do hard money? All of those kind of things where it's just, strictly property based, right? So they'll say, okay, what'd you pay for it? And what is it worth? And then we'll lend you up to 65% of that, and it's going to cost you, right? But it still could be a good deal for you, right? It could be something where because we're working on one of these right now. So they did the hard money, and then now they've shown structure over like the last 12 or 18 months that, the tenant that they have is operating a business and it's growing. But then on the backside, we're already looking at, okay, let's refinance this hard money thing. We have a lot of stability. They have a good lease, and they have a personal guarantor. So like, let's get our owner of the building something more attractive and better for them, that then throws off more cash, so they're not paying this hard money loan.
Yeah. Oh, that's great. So that's even, a good example of just helping the client on the front end, but then also having a solution for the long term. So that's great.
Yeah. And that kind of gets back to where we're just not transactional. We very much care about our clients. And so we always think of it as a one-to-one relationship our way coming to us. So like if you're investing, if you're the investor and I'm working with you to purchase a new property, we may have 10 other clients that we're working with at the same time, but it's very important to you. So we always make sure that we give you that white glove service, and we're like, okay, 1-to-1, because you're only thinking about me. You're not thinking about my 10 other clients and what other, time constraints or whatever we're trying to do there. You're like, where am I at in underwriting? Where am I at in due diligence? Am I going to hit my deadlines? Exactly. Right. And I'm like, yes, we're here with you. We're lockstep. We're about to, we're breaking the huddle. And we're about to score a touchdown. Let's go. And that's kind of how we do it.
Yeah. That's awesome. How about Aaron? This has been great, by the way. And thanks for diving deep on a lot of those things. Anything else that we haven't, that I didn't ask about that you want to make sure to convey to the audience when it comes to, the lending?
Yeah, I think especially if you're a first time investor, or you've been kicking the tires on, I've been looking on all of the realtor.com, Zillow, all the different websites. The realtor I'm working with, their, his or her special website, and I'm identifying some properties. And I think we can make it work and all that kind of stuff is there is a enormous amount of it's information. Will I call it good or bad? No, it's just information, and you really need to work with a person, right? So yes, you can watch multiple TikToks of guys sitting on the side of a Lamborghini saying, I put 0% down and now I own this building, and it's a rental cow. And and I'm like, can you do that? Maybe so really what it is work with someone like yourself that knows a lot about it, or work with someone like us, and we can kind of help you, right? Because there's a lot of people that call me up and go, well, I want to do one of these DSCR loans, and I heard I can do it for 10% down. I said, there's products that are 10, very few that are 10% down. They all have a cap at like, $500,000 loan or $1 million loan. Do they exist? Yes. Are they feasible? No. Right. It's the same thing with like 15% down and that kind of stuff. Because think about it just real quickly. How does a DSCR loan work? Right. Here's my gross rentals. And on the other side of the seesaw is my, my monthly payment and interest, and my homeowner's insurance, and HOAs if there are any, and my property taxes. So you add those four things together, and let's say that's $5,000 a month, and my rentals are at $60,000 annually. Then I'm pretty close to making that hurdle work, right? So I'm $5,000 a month, $5,000 a month, so I'm there. But if I only put 10 or 15% down or 20% down, my rates are higher, so that pushes my payment up. I didn't put very much equity into the deal, so now my principal is higher, right? And so now I can't get to that number that I want to get to. And I always tell everybody, just go in with a mindset of 25% and you won't be disappointed, right? Can we get you better value, better rate on a product at 20% down and save 5% for you for operating? Yeah, we could maybe do that and find the right interest rate that you're happy with. Or at 25%, the break from 20 to 25% on DSCR loans is probably the biggest sweet spot. If you go 25 to 30% down or 35% down, you've lowered your principal, but your rate really kind of floors out, right? So it kind of gets to a point where it just stops. So I always tell everybody, you can get in at 20, that's skin in the game. 25% is really the sweet spot. That kind of gets you, a low entry point, but then also, or a lower entry point, and then also the best rates. And that's kind of how I tell people.
Yeah, makes sense. How about, how can people find out more about you, Marsh Lending? Tell everybody the best place to reach out.
Yeah. So, our website, marshlending.com, we have a lot of good information there, and there's a contact page. You can contact us, and, usually me or someone from our team will get back in touch with you. The other thing is, we do have, all the social channels, but on YouTube, we just did last year a whole entire panel on just what we've been talking about, investment property, right? So short-term rental. So we had one of my clients who's a huge investor on there answering questions. And then we had one of the best brokers in the area talking about from a realtor standpoint and what makes properties good and then bad. And then one of the top property management companies, and then myself from a lending side. And so we just ask questions from different facets or different looks, right? So what makes a good property? And then the investor would say, to me, this. And then the property manager would say heads and beds and this kind of amenities, that. And then for me, I would say, the long-term appreciation of it and what's the organic growth and those kind of things, right? And so we talked about those. So that's on our YouTube channel. And then if you just want to reach out to us directly, you can just reach us at hello@marshlending.com. That's an email address. It comes right to us, and we'll just answer your question.
Perfect. Sounds good. Well, Aaron, this has been great. I've got two other questions for you. I ask every guest. One would just be any advice that you would give somebody who's maybe just starting out in their investment journey.
Yes. Work with a wholesale broker first, because they have an entire marketplace open to them. If you go to your local bank, They have typically 3 to 5 products that might fit what you're looking for. And it's kind of sometimes banging the square peg into the round hole, right? And then the other thing is use ChatGPT as a thought prompt. Don't give everything that someone gave you, throw it into your ChatGPT and go, can I get a better deal? Because it's always going to say yes, right? But that prompt, we kind of work through a lot of this with our clients now. We'll give them something and then we know the response we get back is straight out of chat, right? And we're like, okay, you're trying to buy a condo on the beach that's non-warrantable and you're trying to do it as a business purpose loan. This FHA answer from your chat isn't going to work, right? And so those are kind of the things that we kind of work through. So, do that. And then, also, listen to your show and then in other shows where there's playbooks like this, where you can get at like a new type of thinking, or there is this whole other world out there outside of just, I'm a W-2 earner. This is my first investment house, right? What can I do? Yeah.
Great advice. Yeah. It's crazy the world we live in now with just having to combat the replies from, the AI that it happens, but it's good. It's very good. It's a good tool for sure. And I certainly use it myself, but it can, if you're relying solely on it and it doesn't always pull or
the
make
answer
that
is
distinction.
always yes, right? I mean, that's it. It's your yes man, right? Hey, can I get a better deal? Yes. There's a bank in Guatemala that's giving you, a better deal, right? And you're like, oh, come on, what are we doing here, right? So that's the thing.
Exactly.
Yeah.
How about last question? Just a book recommendation. Doesn't have to be real estate related, certainly can be, but something you've read that's been impactful.
Yeah. Okay. So that's a great question. I actually brought them. We're down for a wedding. We're kind of on a trip, so I brought some reading. So one of the ones that we do, and I'm sure you probably have heard of before, is Traction. So we read like as a group, 10x is better than 2x, and that was phenomenal. And it kind of introduced us this whole EOS or thinking and process. And so Traction has been a great dovetail with that. And so we're working through Traction on as a team now. And then another one that we actually know the person who wrote this, but it's called The Richest Doctor, and it's really thin. It's a really easy read. And it reads kind of like as not necessarily a story, but what it is it gives you a tale of 5 to 6 different doctors that went through med school together and how they track through life, and it gives them lots of different ways of thinking about how to set themselves up for success in terms of like tax advantages and working with a tax strategist, and there's a lot as we always talk about, a lot of different playbooks out of there, and that's just a good playbook.
Yeah. That's great. Great recommendation. Have had Traction recommended before on the show, but never Richest Doctor. So I'm going to check that one out myself. Aaron, This has been great, man. Appreciate you being a guest on the Wealth Flow, and I think we'll call it a show.
All right. Thanks, Keith. We really appreciate it. Thanks for having us on.
Absolutely. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.